All right, I want to welcome you to How to Invest in the Stock Market Profitably. I'm Stockscores founder Tyler Ballhorn. I will be your host and presenter this evening for this webinar. We're going to talk for 45 minutes to an hour, take you through my approach to the market. We'll discuss all the theories behind it, and I'll take some of your stock questions. We'll try to find some opportunities of stocks to buy. We're going to do a wide variety of things this evening. I am recording this, so if you're watching the recorded version on YouTube, you won't be able to ask questions live, but hopefully you'll get something out of the webinar tonight as well. All right, so just trying to help some people who are having trouble with sound. All right, so the itinerary for this evening, we will talk about the theory behind my approach to trading, behind my approach to investing. I will show you what I focus on, talk a little bit about how long it takes to do the process, whether you want to be a day trader, swing trader, and position trader. And then we will take a little tour of the Stockscores Education Center where you can learn about how I invest in the market. And then finally, at the end, we're going to do a search for opportunities, actually do some market scans using the tool on stockscores.com, which I use to search through the entire North American market in search of stocks that meet the requirements of a strategy. And we'll do that at the end. And I'll perhaps have some time to take a few questions on individual stocks as well. So let's begin right away with the theory behind the Stockscores approach. Now, our aim is to find market-beating stocks. If all I want to do is perform as the market does, then I can just randomly pick a few stocks, or even simpler, buy the market index. Many of you are probably aware that there is exchange traded funds that match what the overall market is doing, and you could simply buy those and earn what the market earns, less their little bit of a fee that they charge. That's not my goal. I don't want to be average. I want to beat average. And in order to beat average, you have to have a methodology that allows you to find what we call alpha stocks. Alpha stocks are those that are moving faster than the market. So this is an example, and we're going to use examples from the Canadian and US markets tonight. I'm in Canada, but I spend most of my time trading US stocks, but many of my students and users of Stockscores trade the Canadian market as well. So this is an example of a stock that obviously beat the market. Buy signal was there. It made a big move from just under $75 to $115. That's the kind of stocks that we want to buy as investments, those that outperform the overall market. Now, why do stocks move in strong trends? What was it that motivated that stock to move much stronger than most? And the answer is that stocks will beat the market because they have things going on in their business which allow that stock to sort of decouple from the overall market and move faster than it. So I'm getting into a little bit of theory now. There are two risk factors in a stock's price movement. So when a stock goes up, when a stock goes down, there's two things that motivate that. One is the movement of the overall market. And in the past 4 or 6 weeks, we've seen a dramatic drop in the overall market because the overall market has been the victim of the COVID-19 virus globally. And so most stocks have gone down. Now, not all stocks have, but most stocks have gone down because most stocks have simply traded with their correlation to the overall market. Now, the overall market dropped 30%, 35%, depending on which index. Some stocks dropped 70%. Some stocks only dropped 5%. And so why the difference? Well, the difference comes down to their correlation to the overall market. So airline stocks did much worse than the overall market because, of course, they are much more a victim in terms of their earnings potential and loss of business because they have got, obviously a huge correlation to what happens with the COVID virus really affects their business. On the other hand, a company like Blue Apron, which delivers meals to your door, well, they've done pretty well because they benefit from that virus. And so stocks that outperform the market have something called alpha, and that's our second characteristic of what determines a stock's price movement. The alpha component are those things unique to the company. And so, for again, a company like Blue Apron, which delivers food to your door, they have that alpha component, they have that factor which allows them to perform better than the market. Now, as an investor, what we want to find is alpha. We want to find those stocks that can move up faster than the overall market. And that is not a hard or not an easy thing to do, but it is a simple thing to do. And I'm going to show you how I do that as I go through the presentation tonight. So if we go back to this chart, the greatest sign of alpha is abnormal trading activity. And that's really the core basis of my approach to investing, is I'm looking for stocks that behave, that move up abnormally in price with abnormal volume. So if we look at this stock, there are a couple times on this chart when it showed characteristics of alpha. And the most obvious one was right here when it made a price jump for that week that was significantly more than normal. You can see how the stock normally moved, and it traded with much more volume than normal. Now we can get some help using the Stockscores indicators. One of the things we use the Stockscores indicators for is this green line needs to be above 60 and the blue line needs to be above 80. That happened that week as well. The stock jumped up through this ceiling price at about $20 a share, where it had not been above that ceiling price for a number of months. Now notice that this is a weekly chart and it goes back 3 years. So in this case, in September of 2018, it went up to $20 and it got stuck, and it went down for 4 or 5 months, and then it went back up to $20 and it got stuck for another 3 months. And then finally on this week, in the middle of May in 2019, it was able to break through that ceiling price with abnormal price movement and abnormal volume. And that's really the formula, if you will, of what I try to find in a normal market. Now we're going to talk about the post-COVID market later tonight, because what we're doing right now in a very unique market condition is different than what I would normally do. I wanted to give you a little sort of hint about what I would normally do in a normal market, and that's what it is. It's looking for abnormal breaks from predictive chart patterns. And it's pretty simple, but you need good tools to find them. So the pattern on this chart is something called a cup and handle pattern. And if any of you have ever read a book on chart analysis, you will know that that's a pretty well-known pattern. You can see the little cup here, and you can see the handle over here. It's a period of sideways trading, which in this case lasted 2.5 months. And then we had the breakout week right there with the big volume. The stock moved from just under $25 to nearly $75 in the course of, 8-9 months. So we're talking about a stock that almost tripled, probably a 250% gain over the period of 8 or 9 months. So that is obviously beating the market, moved faster than the market. And I find these stocks without knowing anything about what the companies do. I don't care. What I trust is that the people who know the most about the market, who follow the market the closest, who follow this stock the closest, those large institutional investors that really dig up the best information. The reason this stock went up on this week right here is because those large investors knew something that perhaps the rest of us did not. And they bought that stock aggressively, pushing it up through that $20 ceiling price with very strong volume because they had a reason to. That stock traded over 40 million shares that week, which was much higher than normal. Stock normally trades around 10 million shares a week. So in that 1 week, it traded 4 times its normal volume, and it made a price jump that was significant, that really stands out when we look at it visually. And the investors that did that are the ones who know the company the best. And I do not know this company or really any company the best because I don't follow what companies do. I just follow what the people who know the most do. Now, I'm going to tell you a little story about a unique creature in the ocean called a remora. Now, a remora is that little fish that swims underneath the shark. So you've got the shark swimming around the ocean, and I would compare the shark to the large investors, the large hedge funds, the large institutional investors, the ones with billions of dollars to invest. Those are the sharks. They have the best information. They have the capital to move stocks up because of their size. You and me and every other retail investor out there, we are not the shark. We are the remora. We swim underneath the belly of the shark and we wait for little bits of food that fall off when the shark has a meal. But we're with the sharks, we're following them and doing what they do without putting in all the work. And that's sort of how I invest, and that's how I've been doing it for 30 years. I don't know why the large investors were buying right there. I don't really care. Just like the remora, it doesn't care how that shark found the big fish that it ate. All it cares about is the little tidbits that fall its way, and that's all I care about. I get to come in and do what the large investors are doing and enjoy the same gains as the market moves that stock higher. So now we're going to go on to my third point, and this is a really critical thing that everyone should take to heart. And that is the stock market is not fair. There are always going to be some investors who have better information than others. And they can get that better information because they have particular insight into an industry or into a company, or they have better contacts where they can just simply get better information. They have very smart people working for them with a lot of resources to uncover good information with good analysis. But what everyone should appreciate is that as small retail investors, we do not have an advantage in the market that comes from information. We do have an advantage, but it is not from getting better information. Our advantage is that we are small and we can be nimble. We can move in and out of stocks much quicker than a large investor could. You know, a large investor that wants to buy a $100 million position in a company takes time to do that. On the other hand, you or I, who maybe wants to take whether it's $1,000 or $100,000 position in a stock, can do that pretty easily. We can be in and out within seconds as opposed to days or even weeks. So, where the stock market isn't fair for us is that we don't get good information. But it doesn't matter because the people that get better information leave a trail for us to follow because they tend to be large investors. And those large investors, when they have better information, they push the stock around significantly and they create the abnormal activity that I follow and what we looked at on the last slide. And where we have an advantage is we can move in and out much quicker than the large investors. So ultimately, we can outperform the market much easier than the large investor can because we can follow what they're doing, but we can move in and out quicker. Now here's an example where we didn't have good information and yet we could take advantage of this. This is a company called Transat. It's listed on the Toronto Stock Exchange. And what's interesting about this is it started to behave abnormally right there. Traded very strong volume. Prior to that, nobody cared about the stock. It was just kind of meandering along. And then one day, this is a daily chart, by the way, one day it traded up significantly on strong volume. Well, it wasn't until up here that the company announced that they had an offer to be purchased. And the stock made a huge jump that day, but yet some group of investors heard about that information much earlier, and they bought that stock on the rumor. because they had some, call it inside information. So we want to be with that group that knows more. We do not want to be with the public who are buying when the news release comes out. The public is always last to know. Now, the next important concept that we need to understand is that even if we are following the people with the best information, even if we are being nimble, even if we are using a great strategy, a great approach, we should not expect to be right all of the time. There is too much uncertainty in the market for that to happen. And so I approach the market with the expectation that I will be wrong some of the time. And therefore, I need to practice good risk management. Because what's important in trading is to understand that it's not about what you did on your last trade. Your performance is measured and really determined by what you do over the last 10, 20, 100 trades. We should never judge our performance one trade at a time. We should look at how we do over a large number of trades. And that means that when we are wrong, we should take a small loss. Now, the question that I'm often asked is, well, how do you know how much of a loss to take? And some people will say, well, never lose more than 10% on one stock, or never lose more than 2% of your capital on one trade. And I think that those ideas are better than none, but they're really not a great way to manage risk. So let me show you how I do it. Let's say we have a stock that's trading in this sort of sideways trading range like we've seen in some of those charts tonight. And then one day it makes a big price jump. Maybe this is $10 and it jumps up to $13 in one day. And the volume, which was kind of quiet, also spikes up. So now we say, okay, that stock broke through a ceiling price at $10. It jumped up to 13. It traded big volume. It has all of the characteristics that we look for. So we're going to buy that stock at 13. Now, where do we plan to lose? Well, the investor who says, I'm only going to risk 10% of the value of my trade on that trade would say if it goes down 10%, which means going from $13 down to $11.70, because a 10% move down on a $13 stock is a $1.30 move to the downside. So sorry, this should be $12.70. No, $11.70. I had it right the first time. That's where they would put their stop loss order at $11.70. Don't do that. Don't do that. Because that is just some arbitrary number that has no basis in the stock's price history. What I like to do is I like to look at the floor price that the stock had before the abnormal activity. And I'm going to show you this on a chart in a moment. But this stock had traded sideways at around $10, which tells me that if it falls back below $10, then there's something wrong. Then this original breakout here was not accurate. So let's look at an actual example. So this is CIX, and this is a stock that I featured in one of my newsletters or websites or something back on this week right here. Why? It had everything I look for. It had broken its downward trend line. It was building rising bottoms. It was breaking through this resistance level. This is a pattern or a strategy I have called the bottom fishing pattern. Works great. And in this market right now, it's going to produce a lot of good opportunities. But in this case, it was wrong because the entry signal was there. And so I planned to lose if it falls back below that floor. And it did so right there. Now, it just barely went through that floor. But nonetheless, it went through the floor. And you can see that it went up for a little bit and then ultimately we got pummeled lower. Now let me just go through the risk management calculation for this trade. Okay, so if we look back to when it gave its buy signal, it was right here. And that was at, just for the sake of simplicity, we'll say that was at $21. And again, for the sake of simplicity, we will say that the floor price was right there at $18.50. So we're buying at $21. and our stop loss is going to be at $18.50. So what's the difference between the two? It is $2.50, right? That means for every share that I buy, my risk is $2.50. If I buy 100 shares, my risk is $250. If I buy 200 shares, my risk is $500. So how many shares you buy is based upon how much you are willing to lose. If you are comfortable losing $250, then you buy 100 shares. Now, what do most people do? They look in their brokerage account, they say, oh, I've got $12,000 of cash, I'm going to put it all into that stock. And they don't think about the risk of the trade. So in this case, if you wanted to take $250 of risk, you're going to buy 100 shares. 100 shares times $21 is $2,100. That is the position size that you would take for this trade. All right. So that's our risk management component. Super, super important. Our number one goal is not to find winning stocks. That's probably our number two goal. Our number one goal is to preserve our money. Because if we suffer big losses, we will be out of business as traders, as investors. So our number one goal is to preserve our capital, which means we have to be willing to take small losses when we are wrong. Now, when we are right, we need to let the trade work. And the tendency, if you are a normal human being, is to sell your winners too early because you are afraid of a winner turning into a loser. And so if we go back to our simple example, we've got our stock that's doing this, it breaks out, and then maybe it pulls back for a few days, and then it starts going up, and then it has a little bit of a pullback, and we sell there. And then it rebounds, and it just keeps on going up. And we got out early because we didn't have a plan for when to exit. Now, my rule is that as long as the trend is intact, we're going to stick with that trade. What is a trend? We just draw a line across the bottoms. So those are all the bottoms. We draw a line across it. As long as that line is intact, we can stick with it. Now, I have to teach you a little bit more about how to draw a trend line. And there's times when we make the trend line steeper. Those are some of the things I teach in my course material. Tonight, I'm giving you sort of a broad overview with some concepts that hopefully you can take away and use right away. So here is another example. Let's walk through the trade. So we had an abnormal price move here. Our stock scores had gotten good after being really kind of bad for a while. We broke a downward trend line. We built a rising bottom. We broke from the rising bottom. So that was a good buy point. Then the stock went into a nice long upward trend that lasted from March of 2019 until it was broken right there in March of this year. That's the COVID-19 correction right there. So it broke down through our trend line, let's call it $13. Our entry point was about a year ago at just under $6. So it was a double. Now you could say, yeah, but Tyler, look, it's back up. It's back up to 15. I don't want you to think like that. In this case, yes, but how many stocks ultimately did this when they broke their upward trends in the last month or two? Most have. And so that's the right thing to do. When that upward trend line gets broken from a falling top, then we're out. Now, what is a falling top? Well, here's a high. Here's a falling top. There was the break of the upward trend line, $13, you're out. But up until that time, it was just kind of doing nicely, making some waves up and down, and really was a great performing stock. The temptation to sell that stock maybe here when it started to show a little bit of weakness, or over these 5 weeks when it was showing some weakness, is very real, but it never broke the upward trend line. So you have to stick with them because your winners have to pay for your losers. Remember, we are not going to be right all of the time. If we are let's say, right 70% of the time, and when we are right, we make an average profit of 4 times what we lose when we are wrong. So if 30% of the time we lose 1, 70% of the time we lose 4, that has what we call a positive expected value, because overall we expect to make money when we have a strategy like this. Now let me ask you this. Let's say that I had a strategy that was right 90% of the time. So it was right and it was wrong, lost money 10% of the time. How many of you would want to buy or use that strategy? Most would say, yes, I do. However, what if when you are wrong or when you are right, you make one, let's call it, just for simplicity, $100. And when you are wrong, you lose $2,000. So 9 times out of 10, you make 100. 1 out of 10, you lose 2,000. Is that a good strategy? Nope. Because if we say 9 times out of 10, you make 100, that means 900. 1 out of 10, you lose 2,000. That means overall, you've lost $1,100. So this emphasizes, again, the importance of controlling the size of your losses and letting your profits run. So now what do I focus on? When I am looking for investment opportunities, I'm not talking about day trading. We'll talk about day trading on Thursday's webinar. When I'm focusing on investing, I'm looking for these things. I want to see abnormal trading activity from a predictive chart pattern. We're going to practice good risk management. We're going to be patient with our winners. We should not try to be getting in at the low or out at the high. That is an unrealistic expectation. So let's go through an example. Air Canada. This is a weekly chart going back 3 years. We had strong resistance right here. This is a pattern called an ascending triangle. So I teach maybe a dozen patterns. This is probably my favorite for long-term buys. And we'll call this the breakout. Now you might say, well, there isn't very strong volume there, but remember that this is a weekly chart, and sometimes we just have strong volume on an individual day that week, and so it doesn't show up on the weekly chart. Notice the stock scores are in a good place. They're above 60, above 80, which for this strategy is important. It's not important for all of our strategies, but for this one it is. All right, so we're going to buy it here, and we're going to plan to lose. Again, it's hard to say from the weekly chart, but let's say we're going to plan to lose here. So we're buying at, I don't know, 32, and we're going to plan to lose at 27. So our risk is $5 a share. If we buy 100 shares, our risk is $500. Now the stock went into a nice upward trend, and it broke the upward trend right there in February at, you might have argued that it was breaking it there. I'm going to give it the benefit of the doubt at that point, but definitely here at $42, it broke the upward trend line. All right, now remember, we bought at 32. We bought 100 shares. So 32 times 100 shares is $3,200 for that investment. We sold our 100 shares at $42, so we made $4,200 come in, $3,200 went out, so our profit was $1,000. That means we doubled our risk. So we were risking 500, we made 1,000, which actually isn't that great. A 2-to-1 risk-reward ratio, it's okay, but I'd like to do better. But more importantly, we sold this stock before it did the bungee jump. You didn't need to know anything about how that virus was spreading or how it was going to affect earnings at Air Canada. All you need to do is follow the money. And the people that know the most were the ones that were causing this selling pressure that really started there early in February, and it sort of accelerated. Actually, it was early in January, and it accelerated into February. And the public were selling in a panic way down here, when actually you should be thinking about buying that stock right now. Why would you think about buying it right now? Because this is fear-based selling, and that's the opportunity that we have in the market right now. And it is, in my mind, one of the greatest opportunities I have seen in my 30 years of trading. The amount of volatility and the real fire sale that we see on a lot of different stocks is awesome. But it's going to take some time for this market to turn around. There's no doubt about that. But fear tends to push prices too low. Crashes, corrections create opportunity. Because if you go look at the history of the market since it was started, every single crash has resulted in ultimately higher prices. Because over time, the market has always done this. Now, yeah, there was the crash in the 20s, and then it did this. And there was the crash in 1987, and then it did this. And there was the tech bubble bursting in 2000, and then it did this. And then there was the financial crisis in 2007, 2008, and then it did this. And now we have this one, and I'm quite confident that once again, it will bounce back. And a year from now, these stocks, not everyone, but some, most, will be higher. I really believe that. Now, I may be wrong, which is why we must use good risk management, why we must plan to lose, but that's my expectation. And if you can buy, a stock like Boeing, which was $350 before the crash, and buy it at $110, which is where it was when I first bought it a few weeks ago, and then 3 days later it's at 170, 180, that's the opportunity. And there's still lots of opportunity in this market. It's like we've never seen before. So what is working now? Because as I said at the top of the presentation, this is not a normal market. And so my normal scans, my normal strategies, you're just not going to find anything with them because we've just suffered the fastest decline in the history of the stock market. Not the biggest decline. We've had bigger declines than we've had so far. This decline was about a 35% decline. We had almost a 50% decline out of the financial crisis. But this is faster. The financial crisis decline took over a year, and this decline happened in 3 weeks, 4 weeks. So it's been very dramatic. Now we've bounced back and made back some of that loss. It went down 35%. We're now down around 20, 25%. But as I said, the COVID crash has created great opportunity, but the strategy to take advantage of it is different than what we would usually do. And so I have something I've sort of invented in the last few weeks, but it's really based on things that I've used in the past when there have been crashes, and we'll call it the crash reversal pattern. What we want for the crash reversal pattern is a stock that suffers a strong and emotional sell-off. And then it breaks the downward trend after the formation of a rising bottom. We're seeing lots of stocks do this right now. And we're seeing stocks do it and then 4 days later do it again after they may have gone up or down. For example, Boeing was going down like this. It broke at 110. It went up to 185. It went back down to 150, and then it started to go up again. So we're seeing these patterns occur over and over again. Tonight I'm going to try to find some for you, and we'll do some little searches in search of those things. And we'll actually build a market scan to look for them using the market scan tool on Stockscores. So here's Air Canada again. Crash reversal pattern. Downward trend line. How did I draw that? All I did was just draw it across the peaks. Okay, you want to draw a line that best fits as many points as possible. That's how you draw a trend line. Rising bottom, you can see that the lows here are higher than the lows here. And then we broke the pullback. We broke the downward trend line 4 days ago. All right, that's our crash reversal pattern. We had a downward trend line, we built the rising bottom, we broke the downward trend line. I'd like Air Canada to go higher in the weeks and months ahead. I think this is a good stock for everyone here to consider tonight. However, you have to be comfortable with the risk. Because if you're buying it here at $20, you should be planning to lose if it falls below that floor. And my guess is that floor is at around 14, maybe a little bit less. Which means for every share you buy, if you buy one share, your risk is $6 a share, because we're buying at around 20 and our support is at 14. So if you buy 100 shares, your risk is $600. If you buy 1,000 shares, your risk is $6,000. How many shares you buy is dependent upon the amount of risk you are willing to take. And you have to be comfortable with the risk. If you can't sleep well risking $600, but you're okay risking $300, then your position size shouldn't be 100, it should be 50. All right, so hopefully you get the math around that. So how long does it take to do this work? Well, my normal strategies are listed here. These are my normal investment strategies. So we have 4 strategies that take about 15 minutes a day to apply using the market scan tool. You don't have to apply them every day. Not everyone wants to work on the market every day, so no problem. We have other strategies that take 15 minutes a week. You can do it on the weekend. So I've listed those there. Now, I haven't included here my COVID crash strategy or the crash reversal pattern, but that would fall in this group that takes about 15 minutes a day. We're actually going to do this tonight together. We're going to build a market scan together in search of these opportunities. So how we find things like this is using a tool called the Stockscores market scan. It allows you to scan the entire North American market in minutes. There's, 30 or 40 filters in that tool, which you can combine and use to identify opportunities. Now, normally you would use one of our preset strategies, but because we've got kind of a crazy market, I'm actually going to build one with you tonight that members of Stockscores can use and save for themselves. So let's jump over to the Stockscores website. This is what the market scan looks like. And you can see that there are all these filters here. There's lots of them. And we can combine them however we want. So for example, we could say, show me all the stocks on the New York Stock Exchange that have a sentiment score greater than 60, a signal score greater than 80, and we're up at least 1% today. Really a simple strategy. Probably won't see too many because most stocks don't look all that great. There's 38 stocks on the New York Stock Exchange that have those scores in the right place, and we're up at least 1% today. And if I wanted to, I could then look at their charts and look at the patterns that I see, looking for the right kind of chart pattern. So I'm just going to cycle through these, see if there's anything good. Now, I'm looking for a very specific pattern or one of very specific patterns, stocks that are breaking from sideways trading with abnormal price, abnormal volume, and the process is just cycle through charts. Now, I don't like any of these so far. Wouldn't buy any of those. But that's the normal process that I would do in a normal market condition. We're not in a normal market condition. So let's build a different strategy. Actually, let me just touch on one more thing. Now, you don't actually have to set this up for yourself because I've built for you presets. So if you are a position trader and you're looking to apply the abnormal break strategy or the action candle breaks, let's actually run the action candle breaks. We might get a few of those today. Run the market scan. 20 stocks meet the rules of that. Now, the last time I was looking at the charts, I was viewing one chart at a time using what we call our slideshow viewer. But we also have something called a gallery viewer, where you can look at 10 charts per page, so you can really zoom in or go through a lot more charts quickly because of this. So I'm looking again for a very specific pattern. What I want to see with this particular strategy is a stock that breaks its downward trend line from a rising bottom. Now, this stock had some gains today on good volume, but you can see it's still below the downward trend line. So because of that, this is a no. It doesn't quite meet the rules of the strategy. So that's how we can use presets. But we're going to build our own scan today. So Stockscores members, if you're watching this live, you probably want to write these down, although you can go back to the video later and watch it. I'll have this video up on YouTube soon, like within the day. So let's build a scan. Let's do this strategy on, let's try, let's do the Canadian market. So we'll say all Canadian. And we're going to look for stocks that have lost 30% of their value at least in the last 200 days. So the way we do that is with the gain loss filter. All right. And we're going to say we want them drop minus 30. But of course, minus 30, we have to say less than minus 30, because minus 31 is less than minus 30 over the last 200 days. We want stocks that have really been beat up, that have had a big emotional sell-off. Now the next filter we're going to do is on this candle right here, this candle filter. We're going to set that to bullish. What that means very simply is that the stock closed above its open today. So if it opened at $10 and it closed at $10.10, then it is closing above its open. That's good. Now the other thing that we're going to do is we're going to add in a filter here for the moving or the trend. Where is it here? Under momentum, we've got short-term trend. We're going to set that to bullish. Bullish just means the trend is up in the last 10 days. So it's starting to recover. We can set these to bearish. So it's still in a longer-term downward trend, but in the last few days, it started to turn higher. And let's call this the COVID vaccine strategy. We're going to click on Save Scan. All right, so I've given it a name. I've said to save it. I'm also going to set number of trades. This is really a liquidity thing. I'm going to say it has to have traded at least 250 times today. Run the market scan. Now what I just did is a fairly advanced thing. Most of my students don't ever build their own scans. I just want to show you that it's possible. Most of my students will just use the presets, but I thought it'd be fun to do our own tonight. All right, so it found 53 stocks that have done that. That's just the Canadian market. If we ran that on the US, we'd get many more. All right, we're going to check out the charts. And I'm looking for that pattern that I showed you earlier, the crash reversal pattern. I want to see stocks that have broken their downward trend line that are now breaking up from a rising bottom. All right, so here's one right here. Here's a stock that has had a big sell-off. It built a rising bottom. And 3 days ago, it broke from a rising bottom after breaking the downward trend line. That looks pretty good. I say pretty good because it's got a couple issues. One of the things that I teach in my courses about where resistance is. There's a lot of volume that traded on this stock in this price range. And so all of these people that bought back in late 2019, early 2020 have been losing money for a while. They bought the stock between 80 cents and $1. It went all the way down to 30 cents. They're going to probably be looking to sell when the stock gets back up to that price. And so that limits the upside a little bit. So that's one issue with this one, is that the upside is probably $1 before it gets stuck. Now 60 cents to $1 is fine, but from a risk-reward trade-off standpoint, it's not great because your stop loss on this one is around 40 cents. You're buying it at 60 cents. Your upside is $1. It's about 2 to 1 upside for the risk that you have to take. It's good, but it's not great. Let's see if we can find anything better. Now I'm going to go through these fairly quickly just so this doesn't turn into a long process. Some of those were okay, but I'm going to try to have a little higher standard for what we consider good. This is one that I think people should watch because it is building a rising bottom. And if it can break through this ceiling price right here at about $1.70, I think it could be a good recovery candidate. So WCP on the Toronto Exchange, if it can get up through 170, it's decent. Now remember, I'm doing this on the Canadian market, but you can do it on the US markets as well. I chose the Canadian market just because I didn't want to go through as many charts tonight. You will get fewer on the Canadian market simply because it is a smaller exchange with fewer stocks listed on it. All right, so we're going to go on to the next page. And when I see one, I will let you know. So this is one that did this a couple of weeks ago. I bought it. It built, and it's hard to tell because this scale is so skewed, but it actually built a little rising bottom there, and it broke from the rising bottom there just over $3, and it's been sort of inching its way higher. Now that may look like so minuscule because of this, but on a percentage basis, a stock that goes from $2.50 to $4, percentage-wise, that's a 50% gain almost. That's actually better than a 50% gain. All right, so let's, I just wanted to highlight that one. Let me see if I can find something fresh and tasty for today. All right, this I like. Okay, so this is Auto Canada. This company owns a bunch of car dealerships, a whole bunch in Canada. Suffered a big decline, makes sense. People can't buy cars when they can't go out of their house. There's the downward trend line. There's the little rising bottom, and we broke the rising bottom 4 days ago. We haven't really gone anywhere yet, so I think this is still valid. Currently, it's got a 6.58% yield, which is really high. I don't know that I would count on that yield lasting because they may have to cut their dividend just because earnings will be down for this quarter. But we'll see. A lot of times these companies have enough cash to get them through a bad quarter. All right, so that was pretty good. We'll just go through a couple more and then I'm going to finish up the presentation. So go through one more page of these. Wajax, also interesting. So obviously a steep emotional sell-off, building rising bottoms, breaking from a rising bottom. Now it may not look all that obvious because we are on the daily chart. Let's convert this or change this to a 1-month intraday chart. And now you can see it a little more clearly. There's the downward trend line. There's the rising bottoms. And there was the break from a rising bottom, and that happened 3 days ago. This one's yielding 14.79%. Again, don't trust that they don't have to cut their dividend because they might have to do that, but still, I mean, just a real bargain if this company can start to recover as the overall economy recovers. Now, I've actually had a few people say this to me, don't you think that when earnings are going to come out that the stock market is going to go back down again because earnings are going to be lousy? So first of all, I agree that earnings for this quarter are going to be bad. However, the market's priced that in. Remember, this stock just a month ago was at $22. Now it's at $10. It has priced in bad earnings. And so when the news of the actual bad earnings comes out, it'll only go down if the earnings are worse than the market expected. And the market expects pretty bad numbers because it's gone from something in the 20s to something around 10. It's already been cut in half. Now we've built the rising bottom, we broke the downward trend line, so that's another one that looks decent AD on Toronto. All right. Okay, so that's how I search for opportunities. It saves a lot of time with that tool. You don't have to know how to set it up. Again, it's a very unique market condition right now, so I wanted to show my Stockscores members a little scan that you can build, but in a normal condition, we're just going to run preset scans. Now you have to know what to look for, and what to look for is taught in the Stockscores Education Center. So if I go into Stockscores or under Trader Training, go to Education Center, this is a member-only area, so you have to be a member of Stockscores. And I can start by looking at the foundation lessons. This is the theory to be able to read charts, do risk management, know when to buy, know when to sell. That's all covered here. Every lesson has a written component. So I can click on this and read about it. It has a video component, so I can watch a video. All right. And then there is a test and an assignment. So here's an assignment. And then there's a little quiz, which is right here, I think. All right, so that's how you work through the foundation. Now, once you've gone through the foundation, then you can start learning the strategies. If you are an investor member of Stockscores, you would look at the investor strategies. So there they are. And again, for each strategy, there's a written lesson and a video. For those that want to learn my day trading strategies, my swing trading strategies, then you would focus on the active trader course where you have all of that there. Lessons and videos. All right. So that's the Education Center. The investor course, if you choose to take that, will give you access to all of the foundation lessons, all of the investor strategies. It gives you access to the market scans in Stockscores in the investor area. So if we go back to the market scan tool, go to the market scan, and then under the presets here, see how it says here investor scans? So you get access to all these scans. You get email support from me as you go through the learning process, and you are given 6 months of access to these tools for free, and then after 6 months, your annual renewal is $300 a year. Now, what I'm doing this spring, which I do every spring, is I'm going to complement all of the live, all of the online material, those videos and lessons and that kind of thing, with some live online classes. So we're going to do a few different things. On Tuesday, April 28th and Thursday, April 30th, I'm going to do an overview class where I go through all the theory. So each night we'll work for about an hour, hour and a half through the theory, and I'm just going to guide you through it, teach it to you live, much like I'm doing this webinar tonight. And then the following week, we're going to practice. We're actually going to do scans in search of opportunities. So much like we did a little scan tonight in search of some stocks that are worth considering, we'll do that for 3 nights in a row. Tuesday, Wednesday, Thursday, May 6th, 7th, and 8th. At 6 o'clock Pacific time, we will spend about an hour looking for opportunities. Now, for those who want to be more focused on the active trader course, which is focused on day trading and swing trading, there's the sort of the bonus stuff that you get. You're going to get a free month of a service that we have called Active Trader. I'm not going to talk about that tonight. I will cover that off on Thursday during Thursday's webinar. Now, the special offer that we have running until Thursday, April 23rd at 11 p.m. Pacific time is that for anyone who purchases the investor course or the active trader course for that matter, between now and Thursday, April 23rd, you will get the overview class, those investor market scanning sessions. These are the investor bonuses. And if you do the active trader course, then you get all of these. You also get the free month of the Active Trader Live, something we call Active Live. Now again, I'll show you Active Live on Thursday, but basically you're watching my analysis screen and I walk you through the trading day for those who want to day trade. Here's the course pricing. This is all Canadian dollars. Investor course is $2,495. If you'd like to do the Active Trader course, it is $34.95. The Active Trader course includes the investor course. If you do the investor course now and in a year you decide you want to upgrade to the Active Trader course, that's the fee, $1,250 difference. If you want to purchase it, super easy. You go Trader Training, learn how to trade, and you can buy it right here on this page. The Active Trader course is there. The investor course is there. There's a video that explains what you get in that course. Here's a list of everything that you get. This is a video explaining the Active Trader course. If you are already, say, an investor member and you want to upgrade to the Active Trader, just go into the Education Center once you're logged in, and you will see here a link. Let's say you're an investor, it'll say purchased. And if you want to upgrade to the Active Trader, you can do so right from here. Now, it doesn't show it for me because I already have all those levels. But if you don't have the Active Trader course, it'll show you right there. All right, so I'm going to, before we take some questions and maybe look at a few stocks, I'm just going to pop up a poll. This will allow me to know that you would like to get a follow-up email, which will have a little bit more information about the different course options. And I don't like to bug people, so if you say no to this, then I'm not going to send you a bunch of crap. Even if you say yes, I send you 1 or 2 emails. I don't I don't like to bug people. So I'll leave this up for a moment and then we will take your questions. I've got a few questions that have come in and I'll try to answer those as best I can, but I'm just going to leave this up for another 20 seconds or so. Now, if you are watching this as a video on YouTube and you don't get to answer, then you can email me. I'll throw my email address up in a moment, tylerb@stockscores.com, or you can just participate in one of the upcoming webinars. I have another one on Thursday, another one on Saturday, and you'll be able to check those out. All right, so I'll take the poll down in 5 seconds. 4, 3, 2, 1. And then we will take some of your questions. So, first question, do you think we are in a bull market trap? Possibly, but probably not. But that's why we use risk management, because I just don't know. Do you have a video on using your market scans? Yep, if we go into the education center, every strategy has a video. And so it explains in that video how to use that strategy. And all of these strategies use the market scan tool. Now there is another video, I think in the free section, there's a video on using the market scan. Here. Anyone can watch these, by the way. These are free videos. And there's one there called Stockscores Market Scanner. So you just go to the Education Center. You don't have to be a member to watch these. So you can check those out. Will stock be available when you want to buy? Yep, they always got something to sell. What to look for if and when the market corrects? Well, we've already corrected, but let's say it corrects again, then you just repeat that pattern that I've talked about, looking for a break of a downward trend line from a rising bottom. I would do that on an intraday chart if we get another down wave in the market. And by intraday, I mean we're looking at say a 13-minute or a 30-minute chart. So if I pull up, let's look at Boeing for fun. If I pull up the Boeing chart and see here at the top of the chart, we have these, we call these our fast links. I can set it to a 1 month, 30-minute chart, and I can look for those patterns. And so Boeing broke its downward trend line from a rising bottom right there. That was at $110 a share. A few days later, it was 180. So now what I would watch for in Boeing is draw a line across these tops, and if it can break that line from a rising bottom, then you'd have another signal. We actually had another one right there on April 6th. Build of a rising bottom, break of a rising bottom from a break of a downward trend line, all good. Will you do a course on shorting stocks? I teach shorting strategies. I would rather, for most investors, that you buy inverse ETFs. In our day trading courses, we do lots of shorting, but for longer term investing, I think inverse ETFs are a better way to go. For an RSP portfolio, do you use the same theory or are less aggressive? So if you're looking for something longer term for your retirement portfolio, then I would just focus the strategy on more established companies and maybe do a more conservative strategy, which is the Stockscores Simple Weekly. So if we go to our investor strategy, see here that says Stockscores Simple Weekly, Canada and the US, that's more appropriate for that longer term, safer strategy. Is there a way to try Active Trader for 1 month? Well, we just did that. We have a trial ongoing right now where you can watch Active Live. That's halfway over. I've never done that before, but we did that for the month of April. So you've missed the first half, but you can catch the second half. If you want to sign up for that, it's right here. It says Active Live for April 2020 for non-members. It's $295. Like I said, you've missed the first half, but that's about the best I can do. I've never offered that before. You always had to be a member, but we did that for the month of April. How much is membership of Stockscores without classes? You cannot use Stockscores without classes. I don't give access to my market scan or to my Active Trader Live unless you have taken one of the courses. Now you might say, well, why is that? Believe it or not, I don't want to have too many customers because the more people that use the tool, the less valuable it gets. The more people I have in Active Live, the less valuable it gets, because we're all chasing after the stocks that are giving the buy signals. And so I limit it by having a higher initiation cost with the cost of the courses. The other thing is you have to know how to do this, and it's not just a walk in the park. You have to learn. And I give you a lot of my time. It takes a lot of my time to teach people and help them through the process. I don't teach a lot of people every year, maybe 100. And so, you're getting pretty one-on-one support from me via email. Do you have any suggestions on trading software to use? Well, for position trading, for investing, I would just use Stockscores and whatever brokerage platform you use. If you are day trading, I like to use TradeStation. Others that are pretty good are TradingView charts, TC2000 are pretty good, but I personally use TradeStation. Are these fees tax deductible? So you can expense your education fees against capital gains as an interest and carrying charge. Now, I will give you a caveat on that. I am not a tax accountant. I'm no expert. Depends what jurisdiction you are in. I know here in Canada, many of my students write off their course fees against their capital gains. All right, let's take a look at a few stocks. I'm not going to look at a lot because we're running out of time here, but T.FRU, it's okay. It never really broke this downward trend line. It broke one here. I think it's good, not great. I'd give it a 6 out of 10. RNET. So RNET had a little bit of strength today with some good volume, but notice it hasn't broken its downward trend line. It's still below its downward trend line. And so it really hasn't given that pattern that we look for. That pattern is build a rising bottom, break from a rising bottom. And we're really just coming off of a low, and we haven't broken the downward trend line yet. You'll have to give me, someone's asking Marathon Petroleum, I think it's MRO, but please give me the symbol because I don't remember them all. There's Marathon Oil. I think that's probably the one you mean. So downward trend line is like that, or maybe like this, and it's trying to break it. See how all these candles are red? That means it's not closing above its open, and so that's not ideal. Now this person's telling me MPC. Maybe that's the Canadian listings. So for Canadian listings, we always put a prefix in front. So T.MPC. See if that works. No, that's Madison. MPC in the US. Let's try that. There we go. That one looks better. So sharp emotional sell-off, build a rising bottom. If it can get through that ceiling price that I've just drawn on there, I like it. It'll show up more clearly if we look at a 1-month chart. So 1 month, 30-minute chart. I would be a buyer of this stock if it can get through $27 a share. So if in the next couple of days it starts to move up through 27 with some good volume, I think it's a good candidate. BMO on Toronto, so T.BMO. So I'm going to look at the 1-month chart on this one, just so you can see how it's behaved shorter term. So there's the downward trend line, and it built some rising bottoms and then broke from the rising bottom right there on April 7th. Hasn't really gone anywhere yet, but I like it. It was one of my picks in my last video that I did. I think it looks pretty good. Someone asking about Halliburton, HAL. So again, because the market is a little choppy on the daily, I'm going to take a look at the 1-month chart, 60-minute. And there we see the downward trend line. We see the build of a rising bottom, and it broke from that rising bottom there. So I like it. As long as it can hold above support, which is at $6, I think it's a good little bargain hunt. It may take some time. It may not do what you want it to do for another month, maybe a week. It's hard to say. But as long as it holds above $6, I like it. Okay, we're going to do one more. Do CCL, which is a cruise line. So again, let's take a look at the 1-month, 60-minute chart. So the first time I traded this, I actually traded RCL, which is another cruise line. It was right here. It built the rising bottom. I did this as a swing trade where I only held for 3 days, had a nice little 3-day run. Again, it doesn't look like much, but that's $14 to $18 in 3 days. Now, what we want to watch for is can it get up through this $14 mark? It's kind of stuck there. It is trying to bottom. You can see it twice has hit $8 and held. A little bit of a choppy chart. The cruise lines, they're really getting beat up by this virus, obviously. And so I don't like them as much as maybe some other names, but I think it's trying and it looks okay. Okay, one more, Suncor. So Suncor is listed on New York and the Canadian market. We'll look at the Canadian one, T.SU. And again, 1 month, 60-minute chart. So here's our crash reversal pattern one more time. There's a downward trend line, rising bottom. It made that break on March 24th at $17 a share. Today it's at 22. For me to like it again, it needs to break this downward trend line after building a rising bottom. Hasn't done it yet. If you bought it back here and you own it already, I would hold, but I would not initiate a new position here. I think it's just not quite time yet, but that could change tomorrow. If it breaks that downward trend line tomorrow, then I'm good with it. All right, so how to register for the course? You can go to the Stockscores.com website in the trader training area and sign up there. And again, if you subscribe or register before the 23rd of April, you're going to get those bonuses for free. Don't wait that long. Like the sooner you sign up, the sooner you can start studying. This market is the opportunity of, I can think of 2 times in my life when I've seen a market like this. One was in the tech bubble, and now, like the volatility, the action is fantastic, but you have to know what you're doing, and I can teach you that, but you got to get started. You got to be willing to put in the work and have the discipline to do what I teach you to do. If you have any questions for me, there's my email address. I really hope everyone will follow me on YouTube. Go to YouTube and search for Stockscores, subscribe to the channel, click on the bell notifications. I do upload at least 1 video every week. It's free content, so you may as well check that out. And yeah, I think that's it for tonight. I want to thank you all for joining me this evening. Reminder, we have another webinar on Thursday. You can register for that at Stockscores in the upcoming events area. And then another one on Saturday. And I got a few little extra videos planned as well. So lots of good content coming. Hopefully you've learned something tonight, and I look forward to seeing you again at a future webinar. Thanks.